Today, you will learn a fourth way to determine sell signals under the Dow Theory for the 21st century. Until now, we have seen the typical sell signal, the lows of the last completed secondary reaction. This was the second one. There was the bear definition, which was the third one. And now we explore the fourth way to exit, to sell under the Dow Theory for the 21st century. Look, we have a bearish trend here. As you can see, the market is going down. And we get the typical Dow Theory buy signal. You see, bear market, lower lows. And we get a secondary reaction. Then after the secondary reaction, we get the pullback, at least 2 days. And there is the breakout above the pullback. And this was the typical Dow Theory buy signal, which I explained in other videos. So you will say, hey, this is nothing new. No, now comes what is new. But to explain the new sell signal, we have to go to this buy. The same happens here with the Dow Industrials. We have the secondary reaction, the pullback, and then the rally breaks up. This is the buy signal. And the same happens with the Dow Transportation. Remember that under the Dow Theory for the 21st century, the preeminent index is the S&P 500, and either the Dow Industrials or the Dow Transportation should confirm. Okay, so we have the same here, secondary reaction, pullback, and we have the buy. The fourth sell signal is really interesting because if after this buy signal the S&P 500 breaks down below the pullback lows, please remember, this is not a secondary reaction. The secondary reaction was this. We had a bear market, we had a secondary bullish reaction against the bear market, and then we had the 2 days, at least 2 days pullback, which is not a secondary reaction. But look, once we are under a buy signal, the market goes down and breaks down below these pullback lows on a confirmed basis on the S&P 500, on the Dow Industrial. Here you have the pullback lows. And also on the Dow Transportation, here we require triple confirmation, because it's really a very exceptional signal. Then we get a sell signal. So I repeat, we were in a bearish trend, the market was going down, then we got the very typical, the plain vanilla buy signal. We had a secondary reaction, we had at least a 2-day pullback, and then there was a breakout above the secondary reaction highs, which makes the typical buy signal. But what's interesting is what happened afterwards. If there is a sudden reversal and then the S&P 500 violates the pullback lows, these lows, the S&P 500 also goes down and violates its pullback lows, and the same happens to the transportation and it breaks down below the pullback lows, then when we get triple confirmation, this is a sell signal. This is the fourth sell signal under the Dow Theory for the 21st century. This is very important because, there is a huge track record for the Dow Theory for the 21st century. It helps us avoid deep drawdowns, because normally when this happens, the market then really goes down with gusto. So to avoid this, we get a very early exit signal.